Now, good news for indebted consumers as their debt repayments will go down slightly, boosting their disposable income. The Monetary Policy Committee of the Reserve Bank has decided to cut the repo rate by 25 basis points to 7.5%. That's in line with expectations. This takes the prime lending rate, the benchmark rate at which banks charge their clients for loans, to 11%. Some relief for indebted consumers as the Reserve cut the repo rate by 25 basis points. The rate cutting cycle will, however, likely be shallow as the risks to inflation outlook are now assessed on the upside. The Reserve Bank expects inflation to remain in the bottom half of the target range through the first half of this year. It's, however, expected to go up to around 4.5% in the second half of the year.
The MPC decided to reduce the policy rate by 25 basis points with effect from the 31st of January 2025. 4 members preferred this action, while 2 supported an unchanged stance. The committee ultimately agreed that it was possible to reduce the degree of policy restrictiveness, making the stance somewhat more neutral. However, all members were concerned about the uncertain global outlook.
Right, let's expand the conversation. Economist at the Stellenbosch Business School, Professor Andre Roux, joins us for a discussion. Professor Roux, very good evening to you. Thank you for your time. I mean, it's a decision which gives consumers who are under some financial strain a bit of leeway. What opportunities does it present?
It does, and it wasn't entirely unexpected. By the way, there's a little bit dampening of the spirit with this almost the same time we saw the announcement of Eskom tariffs going up by about 12%.
Yeah.
But nonetheless, let's not quibble about that one. Opportunity for consumers, well, as you said, consumers have been cash-strapped for a long, long time, not only because of high interest rates, but also the high cost of living and similar events. I think it does mean it should provide some incentive to borrow a bit more money and to spend the money, but only hopefully wisely and not frivolously. So borrow money to buy, if you like, assets and help pay off your bond and maybe even a car. Borrowing money to pay the grocery account is never a smart thing to do. But I think what's more important, perhaps, is almost the subtext of the announcement. As you point out in the introduction, it was not a unanimous decision. The previous 2 were. 2 of the members would have preferred to see rates unchanged. And the subtext is one of almost a cautionary note in various ways, pointing out that in America, as we saw last night, rates were not lowered, which is also suggesting that there might be a delay in further softening in America, because in turn, they fear renewed inflationary pressures, and of course the big elephant in the room is the impact of tariffs. In fact, our committee apparently spent some time looking at a scenario where there's a 10% across-the-board increase in tariffs on goods imported by America. And then that could give rise to a kind of a tit-for-tat situation. It could raise inflation, and that scenario even suggests the possibility of America once again raising interest rates. So the global environment remains very uncertain, and I think whereas perhaps 4 or 5 weeks ago, we might have said that this year we will see possibly 3 drops, we've got to perhaps be a bit more conservative in that way of thinking.
Yeah, you touched on the areas of priority for consumers with this ease. And you spoke a little bit about, perhaps borrow money to pay up your car, your house. What difficulty do banks face? For one, repossessing homes compared to cars. I ask you this because research has shown that consumers are letting their bond go in arrears and build up while striving to keep their car loans current.
Yes, there's always a difficult and unfortunate kind of trade-off. Generally speaking, banks would also prefer to see a softening of rates because, as you're kind of hinting, it reduces the risk of borrowers defaulting. People often think that banks welcome rising interest rates are going to make more money. Not really. As I say, lower interest rates will in many ways reduce the risk of defaults. So it's good news for most. Not so great for savers, of course, but still very attractive interest rates by global standards if you're a saver. Still on the high side if you're a borrower, not the highest in the world, but certainly up there with some of the highest. But let's be thankful for small mercies. We are seeing a moderate softening of rates. There's also a degree of optimism expressed in the committee meeting declaration, saying that there's a chance that our economic growth rate might improve going forward. Not superbly, not profoundly, but any improvement is better than what we've experienced in the last couple of years.
Professor, as we speak about the highs, I mean, there are some lows. You touched on it very briefly in your introduction there as you were answering my question. In fact, in just a short while, right after you, I'll be speaking to the Minister of Electricity and Energy, Dr. Kgotsintso Ramokgopa, about the 12.7% increase. And of course, NERSA having approved a fraction of the power utilities request. What is your input on this, your reaction?
Yeah, well, again, also reflecting on the policy, on the press release this afternoon, where they kind of very carefully say that the inflation risks here are a bit on the upside, especially because of what they call administered prices. So in other words, those prices of commodities or services which are not driven by normal supply and demand, but almost imposed upon us, such as the electricity price hike. And then, of course, as always, we are looking ahead at bargaining for substantial wage increases. That in its own right could be inflationary. So I don't think we need to be too concerned. The expectation is that inflation will remain within the target range, but we know that the governor has a preference for midway, 4.5%, which would suggest that if it threatens that level, he might slow down or postpone, not him, but the committee, might be more reluctant to slow down too quickly.